All right, let's pull back the curtain on some hidden numbers that, secretly control the price of almost everything you buy. They're called foreign exchange rates. And trust me, understanding them can be the difference between making a fortune and losing one. So, could a number just sitting there on a screen actually bankrupt an entire company? It sounds a little dramatic, doesn't it? But this is a constant, real-world risk in global business. The answer is a huge, definite yes. And to see exactly how, we need to take a trip back to the summer of 1997.
So on January 3rd, 1997, things seemed pretty stable. The Thai baht was pegged to the US dollar, and $1 cost you about 25.8 baht. No big deal. But then, fast forward 6 months to July 2nd. The government is suddenly forced to devalue its currency. Literally overnight, the price of a single US dollar skyrockets to over 32 baht. And if you owed money in dollars, well, that was an absolute catastrophe.
Now, try to imagine you're a Thai importer. Back in January, you'd made a deal to pay an American supplier $10 million, and that payment is due on July 3rd. Your whole business operates in Thai baht, and you've just woken up to a total financial nightmare.
And that right there is what we call exchange rate risk. It's this lurking danger that a sudden swing in currency values can flip a good, profitable deal into an absolute disaster. So the big question is, what could our importer have done? How could they have possibly protected themselves from this?
Well, they could have used the strategy called hedging. You can think of it as a kind of financial self-defense. They had 4 main options. First, buy the $10 million right away. The problem, that ties up a ton of cash. Second, use a futures contract, which is basically an agreement to buy the dollars later at a price you lock in today. Third, buy an option. This works like insurance. It gives you the right to buy at a set price, but you're not obligated. Or fourth, and this is more for a big company, you could borrow in dollars to pay off the dollar debt.
Okay, so let's not forget the number at the heart of this. The bill is for 10 million US dollars. That part is set in stone. The real question, the moving target, is how many baht it's going to take to pay it. So if our importer did nothing, if they just crossed their fingers and waited until July 3rd to buy the dollars, this would have been their cost, over 320 million baht. That's a devastating price hike of almost 25% in just 6 months. Ouch. But what if they had hedged? Let's say way back in January, they bought one of those futures contracts. At the time, the 6-month forward rate was about 30 baht per dollar. By locking that in, their total cost would have been a predictable, manageable 300 million baht. And just look at the power of that one simple decision. By hedging, our importer would have saved over 20 million baht. I mean, that's the difference between staying in business and going completely bankrupt. A single contract was the shield that saved them from a full-blown currency crisis. Now, that story shows you the risk for a single company, right? But how do economists zoom out from that and get the bigger picture? How do they figure out the real strength of a massive currency, like the US dollar or the euro, on the world stage? Well, the answer is a little more complicated than you might think.
It all starts with this really crucial distinction: the difference between a currency's sticker price, what we call its nominal value, and its real purchasing power.
See, the nominal rate, that's the number you always see on the news, the simple conversion. But it leaves out one key ingredient: inflation. The real rate, on the other hand, actually accounts for inflation, and that tells you how much you can actually buy in another country. And that is the true measure of a currency's strength. Let's look at a real-world example. Between 2015 and 2020, the euro looked like it was soaring against the Chinese yuan, right? Up by 14%. That's a huge jump. But here's the twist. China had higher inflation than Europe during that time. So when you actually factor that in, the real increase in the euro's value was only 7.6%. So what does that really mean? It means the nominal rate was only telling half the story. That higher inflation in China kind of acted like a cushion, making European goods more affordable for Chinese buyers than the headline number made it seem. But even that, it's still not the whole picture. Because, a country doesn't just trade with one partner, it trades with the whole world. So how in the world do we measure a currency's performance against everybody else all at once? We use this thing called the effective exchange rate. Honestly, the best way to think about it is like a GPA for a currency. Instead of just looking at its grade against, say, the euro or the yen, it calculates a weighted average against a whole basket of currencies from its major trading partners. And here's a quick look at how that weighting works for the US dollar. Back in 2020, The Eurozone was the biggest trading partner, so the euro's value had the most influence, almost half at 49%. Then you had Canada and China next. What this means is a change in the euro's value is going to impact the dollar's overall strength way more than a change in the Canadian dollar.
Now, full disclosure, the actual math behind this can get pretty complex. We're talking about logarithms and stuff. But you don't need to be a math whiz to get the main idea. It's just a smart average that gives us a single score for how a currency is performing against the rest of the world. Simple as that. So let's apply this. Between 2015 and 2020, the dollar's nominal effective exchange rate, so its weighted average sticker price, went up by 2.3%. The dollar got stronger. But, as we know by now, that's not the final answer, is it?
To solve the final piece of the puzzle, to understand a country's real economic competitiveness, we have to combine everything we've just learned, that weighted average and the impact of inflation. This is really where it all comes together. We take that nominal effective exchange rate and then we adjust it for all the differences in inflation between the US and its trading partners. And that gives us the single most important number of all, the real effective exchange rate. And here it is, the final number. Between 2015 and 2020, the real effective exchange rate of the US dollar appreciated by just over 4%. This one number tells a really powerful story about where the US economy stood on the global stage.
So what's the bottom line? What this means is that after you account for all the trade and all the inflation, American goods became about 4% more expensive for the rest of the world to buy. So a stronger dollar actually made the country's exports less competitive when it comes to price.
And this brings us to one final, really crucial question. We're always told that a strong currency means a strong economy, right? But as we've just seen, that very strength can make it tougher for a country's own businesses to compete out there on the world stage. So the question to leave you with is a strong currency always what you want?